Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 6th of March 2022. What's the role of personality when it comes to profiting from the stock market? And what forms of personality are relevant? Let's take a look. The obvious place to start is with your own personality. Myers and Briggs classified people into 16 personality types shown here. Some have even classified people into financial personality types, like we see over here. Now, I'm not sure how useful such tables are, but I do know that understanding your attitudes and risk tolerances are a crucial aspect of investing. Different trading and investing styles do tend to attract different personality types. For example, day traders who buy and sell the price action within a given day should be very focused, be able to concentrate for long periods of time, and they should be pretty stress tolerant and disciplined. In contrast, position trading or long-term investing tends to be less stressful than that. It's important to match your personality with your investment style. The thing you don't often hear is that individual stocks and sectors also have personality traits. The personality is determined by things such as volatility, trading volume, and cyclicality. The volatility of a stock has a couple of characteristics. So one is the amplitude of the volatility. A high volatility stock or sector will have higher risks, but also the potential for greater profits compared to a low volatility stock. It's also useful to look at the symmetry of the volatility. So if volatility is symmetric, then it's going to be equally volatile in bull and bear markets. Equities and gold exhibit asymmetric volatility, but interestingly, this asymmetry is different for the two. So equities tend to get much more volatile in a bear market, whereas gold is the exact opposite. It tends to get more volatile during bull markets. In both cases, the high volatility relates to fear. Let's look at some charts that illustrate this. So here we've got the S&P 500 in bars and the VIX in red. So the VIX is otherwise known also as the fear index. And so that represents the volatility of the S&P 500. We can see here that the volatility spikes tend to occur when there's a significant drop in the stock market. So here we had a massive spike, and that was in that crash there in 2008. And again, we had a massive volatility spike here during the 2020 crash as well. And then you get smaller spikes. So for example, here and here. There's also a couple of spikes back here in the 90s. This chart shows the type of volatility that you get for gold. So this is a specific volatility measure that I found in this publication here. So they've called it conditional volatility. And we can see here that it was very high in the late 1970s, and that was when gold price had peaked as well. But you know, this chart only goes up to 2009, and I don't really know how to, make a chart of this on TradingView. On TradingView, there is a kind of volatility measure for gold, and so this is called the GVZ. That's the ticker symbol, or the gold volatility index, and so that's shown in the bars here, and I've put the gold price here in gold. And the problem here is it only goes back to about 2008 here, and so hard to make out a huge amount of patterns over here really, because here, as gold was going up, this volatility was actually dropping. But then again, over here, when gold spiked up, we also got a kind of preceding spike in the volatility. I think that more coincides with the drop rather than this rise, though. So yeah, it's hard to make that out. I'm not sure how useful it is to use this. There's actually also an equivalent for silver. So the ticker symbol for that is VXSLV. So that's the Silver ETF Volatility Index. And again, you know, it only goes here back to 2011. And it kind of seems to follow what the silver price is doing for a lot of the time here. But yeah, I'm not convinced how useful that one is either. Another form of personality is trading volume. So low volume means thin liquidity. And so in such cases, the spreads are usually wide and the fills tend to be slower. Also, volatility tends to be greater. And so, particularly if you're new, it's best to stick with high liquidity stocks. This is what the chart of a low liquidity stock can look like. So immediately, just eyeballing, you can see that few of the candles actually have any bodies. You know, it's mainly kind of either horizontal lines or wicks, really. And if we look at the volume at the bottom here, there are actually many days where there's 0 shares traded. The intermittent high volatility is also apparent here. So if we look at this line over here, you can see that the price actually tripled from about 40 up to over 120 there within a single trading day, and actually it went straight back down again. And you know, the problem with this poor liquidity also means that it's unlikely that you would have actually been able to profit from this, because you know, this movement can happen very, very fast, and so getting your order filled right at the top is very, very tricky. When you have a thin or illiquid market, there are basically fewer orders to absorb market fluctuations, and so that makes it easier for buyers and sellers to push price up and down. I think that technical analysis becomes less reliable in a low liquid market. I also think that price gaps are more common and are perhaps less likely to be filled in an illiquid market as well, so they're of less importance in terms of technical analysis. Another important personality trait is cyclicality. So cyclical sectors include commodities, IT and industrials. Such sectors are affected by macroeconomic factors, and in general they have a higher volatility than the defensive stocks. But also they do give a high return when the cycle is on the up. Things to consider when thinking about cyclicality are the amplitude and the frequency of each cycle. The amplitude gives you an idea of the size of the returns that can be expected, while the frequency indicates how long it's likely to take to achieve such returns. This chart indicates the commodities supercycle since 1805, and we can see that over time the amplitude has been gradually increasing over here. Now I've written at the top here the time between the peaks and also the time between the troughs along this kind of trajectory here. And so what we can see is that over time the amplitude of these swings have been increasing, and also the peak to peak times have been increasing. The kind of trough to trough times don't seem quite as reliable. This 90-year gap is quite anomalous here. But the good news here is that we're likely to be on an upswing, and this is predicting the next peak at 2045. Whoa. Are there any other ways of defining personality of a stock or sector? Now, I had an idea that might seem a little bit out there, but I reckon it's worth considering. You never know what comes out of random ideas. So, a few years ago, we were for the first time able to detect gravitational waves. So these are ripples in the fabric of space-time that occur when two black holes orbit each other and then merge. And so as a result, those waves result in this pattern here. So this is where the merger is occurring here. So this is a pictorial representation of the waves that are kind of emitted when this happens. Now, they've also been able to convert this visual wave into a sound. And so this is what the sound is like. So I reckon stock prices also move in waves. And so I wonder, is it possible to convert stock price action into sound? Now, I've got no idea where to even start with doing that. My knowledge of music could be written on a postage stamp, and you still have space left over as well. So, yeah, I don't know enough about music to be able to work out how to do this. But my thinking here is that perhaps if we can turn price waves into sound waves, maybe that'll make it easier to kind of discern what the personality of various stocks and sectors are, and that could lead to a whole bunch of other ideas I can think of. Now, I know that we've got quite a few talented bright sparks listening out there, and I know that certainly some of you are musical. So if you do decide to have a go at this and come up with something, do let us know. I would be very, very interested to hear what comes of that. In conclusion, when trading and investing, it's crucial to know yourself. And if it turns out you didn't know yourself, then the market's an excellent teacher. There are many, many trading strategies available out there to choose from, and it's preferable to pick a strategy that suits your personality. But also remember, different stocks and sectors also have their own personalities. And I reckon it can be very useful to understand the personality of what you're investing in. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. And this time I'm using the Oanda chart just because we can get the volumes here. And this just shows the significant increase in volume, and that's been persisting all the way up through this whole move. And I thought that was interesting because, when price moved up here, volume didn't really move up a lot. It was pretty average over here, wasn't it? Whereas, this is doing something different. So that's something to take note of. And to me, that just suggests that we're in the beginning of the next leg up, as it were. This was a consolidation. And here we go, up, 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 hopefully. That's what I'm thinking anyway. And remember that this band that we talked about based on the volume by price, I haven't included it here just to keep the chart nice and clean. And we've actually gone back up there. Now, last week I was talking about how I thought we'd get knocked back down to about 1860. Well, didn't really get that far. It got into the 1870s. And to me, when it doesn't hit my lower targets, that suggests a strong price action there. So that's good news. And what will end up happening, I think, if basically as this uptrend progresses during the shows, I'll usually say, it might come down to so and so level, and often when things are in an uptrend, it doesn't even get to that level. Okay, so just bear that in mind, and that's good. That's what we want. So yeah, we're up here above here, and I think we've got a fair amount of thin air up here. So we might come up, we might retest this as a bit of support over here. So 1960, and yeah, basically moving up. Let's let's have a look at the bigger picture. So this is on the monthly scale. And what I've done here is join the lows. Now it's not absolutely perfect. You can see here there's one tiny green candle that's just gone below that, but I've just excluded that basically. But you can see that it's pretty good on the log scale. But once you get past here, it's actually an underestimate, and so you have to redraw a new line that goes through here. But again, there's only one other touch here. So as this trend progressed, it became harder and harder to work out where the low would be. And so similarly here, I think this part, we're in the part of the bull market that's kind of around here basically, this kind of area, because we are following this line on the log scale. And so I think that's going to be a useful guide. It may or may not touch it again. It's very difficult to tell. Obviously here we had multiple touches here. So let's see, but that might be a useful line to just keep in mind in terms of, for example, when the trend's going to break. Obviously here it was a little bit late to tell us that. You know, there's not a big difference here in the price drop here. So yeah, that's something to keep a watch on. And also someone asked for us to look at that parabolic price chart. Now the log scale is pretty useful as well, particularly in these early stages. As you saw, it fits the line, so that's probably the easiest way to look at it. This one I've done on Excel, and what I've done is I've added this price over here as well. That's where, you know, the last couple of months price has kind of bunched up in that area. But interestingly, when I added that, the accuracy increased even more. I think before that it was 0.98. So that's getting more and more accurate. So this blue line, let's just go over this again. So this blue line is based on the low prices that I've determined by looking at on the weekly scale. And so these are the major lows that I've identified. And these orange dots are the major highs, the major peaks in that price action. And so what we have here is a kind of now again, normally I would have liked to overlay the price on here so you can see that, but I've lost the access to the software that does that. But basically, you know, what you'd see is something like this. Yeah, that's very badly drawn. Okay, but basically what we're looking for is another touch of this line here. Now you can see from these dots that this upper line isn't as good, is nowhere near as good a fit as this one, but it's still, you know, in the 0.9s, which is reasonable. But what it means is that you can get an overshoot or an undershoot. And remember that tops are kind of emotional things. And so actually, I mean, remember this is in a consolidation, so you're kind of on either side of that line. But as you get further up, I'm thinking that you're more likely to get overshoots because of the emotion that you get. And like we were talking earlier in the show, you know, gold price has that kind of character where its volatility increases to the upside, and so that's why I'm thinking that. And so how high can we go? Well, basically it really depends on how long price takes to move up. If it's a slow move up, then obviously it's, you're going to get a higher price action here. So for example here, so let's say it peaked in August, end of August of 2022, then we'll be looking at a target of around 2,800 to 3,000, that kind of range over here. But of course, you know, if it had a sudden rush and peaked up sooner than that, I mean, we're already up to here, but you know, if it peaks before then you're going to probably get a lower kind of price target, and obviously if it's after that, you're going to get a higher one. And of course, you've got to expect it to come back down here at some point as well. Okay, so this is the kind of area that I'm looking at. I might think about doing, remember last year I did that gold trajectory video. Obviously that's going to need updating. But yeah, this still kind of holds, certainly for this parabolic model that we've been looking at. Right. US dollar index. Well, that's very interesting, isn't it? It broke out above this line now quite decisively. We're actually halfway to our target of around 100 at this point. Very interesting though, isn't it? That the dollar and gold both moved up together. So right now they're positively correlated. That's unusual, but it does happen. So, you know, it's not rare, it's not uncommon. So yeah, looking at this, it's looking like the US dollar's got further upside at this point. Interesting. And silver, again, this has moved up quite nicely. This has got a curve to it, hasn't it? I mean, it kind of looks like this curve. And I wonder if we're going to start a parabolic move here. Now, obviously, it's too early to say. And the thing is, silver has that character. We know that. It's done it multiple times on multiple time scales. And so that's why I'm thinking that. So the other thing you could say is that this kind of looks like a double bottom over here as well, in which case we have broken out over here and the target is above that 28 level. And remember that 28 level, here I've got it as 28.26, but basically roughly $28. That's what we need to break, and I think we're likely to, because it's hit that multiple times and been rejected. So I think the next time it hits that, it's going to slice through there, and probably that's going to end up being support here. So interesting. I think more upside for silver. And the miners, so this is the GDX on the daily scale, and so this was the high from August 2020, and we've drawn this line to go through here, and you can see that price was kind of dancing around this level here, and I wondered whether it was going to come back here to retest 32 before moving up, but again, you know, price action was pretty strong. It didn't reach that lower target, so that's a good sign. And we've broken out again pretty decisively here. And what's the worst case scenario here in terms of downside? It could come back and retest this line here. So let's say roughly 34. So, I mean, it could go higher and do that as well. We don't know. Or it might not even bother to do that. But again, looking positive here. We've got this gap over here that's going to likely want to fill as well. So maybe a bit more upside there to come. Now what I've done here is the GDX to gold ratio. And again, it kind of, basically what we're looking for is any upwards move suggests outperformance of the miners relative to gold. And so we're kind of moving up here. We need a breakout above this line. And I think once we get above this area here, it's going to go even further up. But this is a kind of good level here to be in terms of the performance of the gold miners relative to gold. And this is the silver miners, SILJ on the daily scale. And again, similar story to what we have on the GDX. We've had this breakout of this downtrend line. We kind of skirted around that line there, tried to break back down through there, but wasn't successful, and moved back up. So that's pretty nice as well. What we want to see here though is a break up above here, and possibly this could be a double bottom again. But yeah, if we break up above here, then I think the next place that's going to be huge, once we get above this line, it's going to be huge huge for the silver miners. It's going to go up big time. So that's the area to watch. We've been watching that for quite some time. We wondered whether that had happened there and there, but they ended up being false breakouts. So this time we want a nice green candle going up through there. And this is the SILJ to silver ratio. And this is very interesting because can you see this good little green candle just poked above it? And so we've had a close above it, which we haven't had so far. We've got a couple of red candles poking up, but the closes were always below it. So again, in terms of the silver miners, we can expect them to start outperforming silver as we move up through here, and particularly big time once we get above this line over here. So I'm feeling pretty positive for the precious metals prices and for the precious metals miners. Right, that's it. Oh no, it's not. That's not it for me yet. Sorry, I forgot one more thing. This is the gold silver ratio. This is on the monthly scale, and this is just to recap where we are. And so if you remember, around the 80 to 90 has been the kind of historical highs before. Obviously, we had an anomaly here. I don't think we're going to get something like that again. I think that's a low likelihood because it's such a rare event. So I think we're going to be moving downwards. Now remember, the mean is around, let's say, 60. So we're still above the mean here, you know. And so that tells me that things have only just got started in terms of gold and silver. We've got room here, okay. And so right now silver is probably much better value than gold still, just because of where this ratio is. So good, okay, so I think that really is my last chart for the day. All the best and see you next week. Bye.